Welcome, AP Macro students. I'm Mr. Sanabria, and today we're going to talk all about what is known as spending multipliers. You might recall that when we learned about the things that change aggregate demand, the determinants of aggregate demand, I said every change in aggregate demand includes two parts. The thing that actually changes it, which is the determinant, and then the multiplier effect that magnifies or multiplies the change. And I said we'll talk about the multiplier part of this later. Well, today is later. So let's go ahead and begin this conversation by basically acknowledging that this multiplier effect that we're going to learn today applies to any kind of spending in the economy. So we're really going to focus our conversation on consumption spending, which you can see is the word right above my head. So we're going to speak mostly about consumption, but I do want you to understand that any spending change that happens with any of the components of aggregate demand, which is SIG-X, consumption spending being one of them, investment by companies, the government spending, and net exports, any of those actually have a spending multiplier effect associated with them. And we're going to understand why that is later, but I just don't want you right here from the beginning to get confused in that, because we're going to speak mostly about consumers today. Okay, so this effect applies to everyone. And let's just go ahead and get right to the point here. So we have the slide here called consumption and saving, and I want us to just remember that consumption is a determinant of aggregate demand. SIG-X, right? It's the C in SIG-X. And some of the things that would change consumers' behaviors, and therefore changing SIG-X, changing aggregate demand, this is why this is so important, right? The things that might change consumer behavior are change in wealth, change in consumer expectations, a change in household debt, and a change in the amount that the government is taxing your income, right? All of these things are things that could potentially happen, some sort of a positive or a negative, and it would change the way that you spend, change consumption spending. One thing that we've added to this slide is, if you follow my cursor, I'm telling you, with wealth in particular, that an increase in the amount of wealth would be an increase in consumption spending. What's accompanying that is a decrease in saving. Okay, so really with every one of these, and this is kind of a review of the things that might change consumer behavior, if you increase consumption spending, you've got to decrease saving. That's all we're adding to this. So let me go ahead and pull that little bullet point up for you. We're simply adding the reality that increased consumption means a decrease in saving. So today is going to be a big conversation about consumption and saving and how that fits into the bigger economic picture. And really, it's because of consumers' relationship with how much they spend versus how much they save that causes the multiplier effect that we're going to learn today to happen. So make sure you do understand these different behaviors, the amount of debt a house has, or households have, the expectations of the future, taxes and wealth, as things that would change consumption. We're understanding that consumption spending is C in SIG-X. Remember, it's a huge component. It's about 70% of GDP for the United States. And ultimately, big picture, this whole thing is important because anything that changes aggregate demand is recognized as the business cycle itself, right? So aggregate demand decreasing means slipping into a recession. Aggregate demand increasing is a recovery, but if we increase aggregate demand too much, we're getting inflationary, right? We're describing the business cycle, and of course where this whole course is going, where the road is leading, is to counter-cyclical policies. Policies that would be employed or implemented by the government or central bank to counter this effect. Okay, so what changes aggregate demand? And I've said it a lot, but I can't even emphasize it enough. The things that change aggregate demand are just incredibly important to us. So let's go to the next slide here, and I'll get myself out of the way for you. Let's talk about what households can do with disposable income. And actually, before I talk about what households do with disposable income, I need to destroy the myth of what disposable income is. because disposable income as a word is probably one of the most misused words by the American people, or probably people in general, okay? Most of you probably, if you were to close your eyes right now and think, what is disposable income? You would probably say, oh, well, after I pay all my bills and stuff, I have a certain amount of money. Maybe it's like play money, spending money, you know, I could go out to eat with or whatever. That's what disposable income is. Because that's how we use the term disposable income when we normally speak. Here's the problem with that. That's not what disposable income is. Disposable income is simply your after-tax income. So you get paid a certain amount, the government taxes a certain amount of that, and then you're left with money. The money you actually can spend, your after-tax income. So what that means is all those bills we were talking about, they are being paid for by your disposable income. So your rent, your electricity, water, utilities, your cell phone bill, whatever you consider to be an essential expense is actually, that's all disposable income. And even if you're left over with nothing to go out to, you know, get a nice dinner out with your friends, if you don't have anything like that, that doesn't mean you didn't have disposable income. You just spent all of your disposable income on your bills. So we got to have that as our understanding of disposable income. Okay, it's income after taxes. So with that being said, what do we do with it? What do we do with disposable income? Well, you can only do two things. You can either spend it, and if you spend the money, that's consumption spending. Easy, right? And you can not spend it, and that's what saving is. Saving is simply not spending money. I don't care if it goes into a savings account, which is probably where it should be, or if it goes into some sort of a financial product as an investment. That's good too. This is all saving. What if you piled up a bunch of your paycheck in a big pile and then you just burned it all up? That would be saving too. That's what I'm trying to communicate to you. You can spend it, you can not spend it, but if you don't spend it, that's saving. If you do spend it, that's consumption spending. Okay? So that's how we want to think about your disposable income and what you do with it. And this is great because we've got this kind of binary thing, right? There's only two things. You spend it, you don't spend it. If you spend it, it's consumption spending. If you don't spend it, it's saving. That's going to make our lives really easy. Okay? So let's talk about household spending. There's this thing that's called average propensity to consume. Okay? And what a propensity is a likelihood to do something. So if we were to take the average American household, and of course households vary dramatically, right? So this is statistics, right? We're taking an average. And I were to say, okay, the average American household is likely to spend this percentage of their disposable income versus save it. Okay? So average propensity to consume is consumption spending, right? Spending money, consumption, divided by the total amount of disposable income. And then you end up with a percentage of disposable income that's actually spent. So this is really simple, actually. If it doesn't seem like it so far, let me just put it this way. The average propensity to consume in the United States is around 90%. Okay? So Americans spend 90% of their income, and we save about 10%. Does that make sense? So that's about as hard as this is getting right now. So what if I were to say a household spent more than they actually earned? Is that possible? Can a household consume more than its disposable income? Like if you made $100,000 this year, could you spend $110,000? Well, yes, you can. You could take out a line of credit. You could dip into savings that you already have and spend more than you made. And there's a word for this, and that word is called dis-saving. Okay, so dis-saving, that's spending more than your income. So we've learned a new term on this slide, right? We've learned average propensity to consume. And just like an average propensity to consume, there's an average propensity to save. So let's go ahead and take a look at our savings slide. I'm just moving myself all over the place today. So saving is a household not spending, right? We've kind of covered that. You can consume or you can save. So saving is not spending. The average propensity to save is the amount of disposable income that is not spent or is saved on average, right? So the average propensity to save equals savings divided by disposable income. That's the percentage that is not spent. Simple, right? So instead of saying that Americans consume about 90% or spend about 90% of their income, I could just simply phrase it as Americans tend to save about 10% of their income. So if we put these concepts together, then you end up with a couple of, algebraic expressions that make a lot of sense, because the average propensity to consume plus the average propensity to save has to equal 1, right? Because there's only two things you can do with disposable income. You can either spend it or save it, right? So if you spend 90%, you had to have saved 10%, that equals 100%, right? And we're not really talking about percentages. We're just going to leave it in decimal form. So average propensity to save plus average propensity to consume is 1, which gives us a whole series of possible ways to figure out some numbers. If I know the average propensity to consume, then I can just subtract that from 1, and it will give me the average propensity to save. If I know the average propensity to save, I can subtract that from 1, and I get the average propensity to consume. The average propensity to consume, if it's greater than 1, that's dissaving. And if the average propensity to save is negative, that's also dissaving. So let me go ahead and use the whiteboard here to just quickly run through these, just in case just seeing these mathematical equations isn't enough for you. Let's pretend that a household makes $100,000. Not too bad, okay? If the average propensity to consume equals 90%, then what amount they consumed was $90,000, right? So let's figure out the average propensity to save. 1 minus 0.9 equals 0.1. And those decimals are our average propensity to consume and average propensity to save. So the average propensity to consume equals 0.9. Average propensity to save equals 0.1. And that's it. That's all there is to this. Say no more. So let's move on to the next slide, and things are now going to start getting more useful for us. Because there's this other thing called marginal propensity to consume and marginal propensity to save. So take the same concept, this kind of binary relationship, this idea that you can either consume or you can save. And instead of thinking about how much of our entire income we consume versus save, which is average propensity to consume and save, let's think about how much of a change in our income gets consumed versus saved. And all I mean to say here is, if I were to give you $1, how much of that $1 would you consume versus save? So we're thinking marginally here, right? We're thinking about incremental changes. So if I were to give a household a $100 raise, how much of that $100 would get consumed? How much would get saved? So marginal propensity to consume is a change in consumption over a change in disposable income. All right, so that's your marginal propensity to consume. And so let's go ahead and think about the marginal propensity to save. It's the same thing. We were thinking about average propensity to consume and save, and they had to equal 1. So if your average propensity to consume is 0.9, your average propensity to save is 0.1, right? Well, marginal propensities work the same way. So if your marginal propensity to consume is 0.9, meaning you're going to spend 90 cents of every new dollar earned, well, then that means that you are necessarily saving 10% or 10 cents of every additional dollar earned. And so your marginal propensity to consume and save are almost the same thing as average propensities, but the key difference is, and this is a difference that you really must wrap your head around, and you've got to understand this difference, is that as opposed to the average propensities, the marginal propensities are considering your spending and saving habits with new money, money that you didn't have before. Okay, so I give you $100, and of that $100 only, how much are you going to save versus spend? And so then you're talking about the marginal propensities. Okay? Other than that key difference, we're treating these the same. And what the math ends up looking like is very similar. Let's go back. Okay, so your marginal propensity to consume, and the example I've been using is 0.9, plus your marginal propensity to save, and I've been saying then that's 0.1, it equals 1, right? And because of that, there's only two of these, and they have to equal 1. These other algebraic equations apply, and it's quite simple, right? So if I give you a marginal propensity to consume, for instance, of 0.8, you should be able to tell me the marginal propensity to save. Go ahead and think that through real quick. Marginal propensity to consume is 0.8. How much is the marginal propensity to save? Okay, time's up. Hopefully you were able to say, well, the marginal propensity to save would be 0.2. Because 0.8 plus 0.2 equals 1. So what we're going to find is that we actually aren't going to do very much at all with average propensities. This is all about marginal propensities. So I had to explain this concept of average propensity to consume and save, and in order to set up marginal propensity to consume and save. And the reason we wanted to learn marginal propensities is so that we can now go ahead and look at the multiplier effect. Okay, so let's go ahead and start, let's kind of shelf marginal propensity to consume and save and understand that. We're about to return to it, but let's think about this multiplier effect now. And spending multipliers are exactly what we mentioned before, as far as there's that initial change in sig x that would cause a shift in aggregate demand, but then there's this multiplier that makes that shift larger. Okay, so here's like the bullet point that would state that. Let's go ahead and move on and really talk about this. Here is the equation for the multiplier. So the spending multiplier it's calculated by 1 over the marginal propensity to save. Now notice I have the equation written two ways. I have 1 over 1 minus the marginal propensity to consume, or I could state it as 1 over marginal propensity to save. Personally, I kind of ignore the first equation, and I only think about 1 over marginal propensity to save. And the reason for that is like, hey, who wants to memorize a bunch of equations? Not me, and probably not you either. So all you have to do is memorize one equation here, and that's 1 over MPS. So why can you ignore the other one? Well, perhaps you've already noticed. It's 1 minus MPC is just the way you would get the marginal propensity to save. So in any given problem, you may be given the marginal propensity to consume or the marginal propensity to save, but because we know that MPS plus MPC has to equal 1, it becomes very obvious what the MPS is, regardless of what they give you. So if in my previous slide, I gave you the example, okay, what if the marginal propensity to consume is 0.8? You should be able to tell me MPS is 0.2, right? And yes, that's right. You should be able to do that. And so really, you want to get to the MPS and then just think of 1 over MPS. Now, 1 over MPS equals the multiplier. But what is this multiplier exactly, and why does it happen? Let's address right now what the multiplier is, and then we'll kind of address what the question on the screen is, why does it happen? And the answer to the first question, what is it, is pretty simple. It's a number that we're going to multiply the amount of whatever spending we're talking about by, and it's going to give us the total impact of that spending on aggregate demand. Right? Because we know that when consumers spend money, that impacts aggregate demand because it's consumption spending. And when investors spend money and the government spends money and net exports, that is spending as well in the economy. We know there's an impact. And then we know that the multiplier multiplies that impact out. So when we do 1 over the marginal propensity to save, that actually just gives us that multiplier number. So that's simple. So why is this thing happening? And in order to understand that, it's probably most useful to think of the circular flow model and that big, insight that it gives us, which is that every dollar one person spends is another dollar that someone else made. And now we layer on top of that this idea that at any dollar you get, you can either spend some of it or save some of it. And the amount that we, in general, like our propensities, our average behavior, the amount of every new dollar spent is our marginal propensity to consume. And then that amount that we save of every new dollar is our marginal propensity to save. So as this money takes turns being spent and then its income, then that new person who receives income only is going to spend a certain amount, and so some of it gets saved. So the amount that they spend is a little bit less, and so the amount that the next person earns is a little bit less, and then they take that amount and they put a little off to the side and save it, and then they spend it again. So as this money cycles through the economy, it's becoming less and less and less. Okay, so we know that it can only be spent or saved. So given the marginal propensity to consume, this is a typo here, so I'm going to correct that on the slide, but given the marginal propensity to consume and the marginal propensity to save, we can predict how much spending will occur because of some change in the money that is supplied into this cycle of spending. And all of this, finally, is to give us the tools to do the practice problem here. So that didn't work. Let me put myself right here. So I want you to go ahead and take a moment and work through this practice on your own. And then we're going to go through it together. So here's our first practice problem. Assume that a U.S. citizen spends 90 cents for every extra dollar they earn. Further assume that the real interest rate, which is just a small r, decreases, causing a $50 billion increase in gross private investment. Calculate the effect of a $50 billion increase in gross private investment on aggregate demand. So go ahead and take a moment and do that now. Okay, so hopefully you paused it there. You worked through this practice problem, and you're going to be able to go through this with me now. So let's say first step is calculate the marginal propensity to consume and the marginal propensity to save. So from the example, we know, and if you'd like to see the calculations, here they are if you follow my cursor, but it's pretty plain to see that given the information that we spend 90 cents for every dollar we earn, that the marginal propensity to consume is 0.9, 90 cents out of that dollar. And that makes the marginal propensity to save 0.1. So our first step in doing a problem like this is to calculate the MPC and the MPS. So we know that the MPC is 0.9, the MPS is 0.1. So what are we going to do with that? Well, we need to calculate the spending multiplier. And so we have 1 over the marginal propensity to save. We already established that the marginal propensity to save is 0.1. 1 over 0.1 equals 10. So 0.1 can go into 1 10 times, right? So our spending multiplier is 10. Finally, given the spending multiplier, we can calculate the change in aggregate demand. So you have whatever change in sig x, in this case it's a change in gross private investment, times the spending multiplier. Our example gave us a $50 billion increase in gross private investment. So $50 billion times 10, which is the multiplier, equals a total $500 billion change in aggregate demand. So if when you went through this on your own, you didn't quite understand the framework or what we were trying to do, here it is for you. 3 steps. Figure out the marginal propensity to save. Then step 2, calculate the spending multiplier, which is simply 1 over the marginal propensity to save. And step 3 is multiply the multiplier by the amount of spending. And that gives you the answer. So let's talk about what happens if taxes change. We have something called the tax multiplier. If the government raises your taxes, the multiplier kind of works in reverse, meaning the amount of money being taken out of consumers' hands gets multiplied out. So you end up with this negative impact on spending. Does that make sense? Why? Well, now money's leaving the circular flow. Okay? Money is leaving the circular flow of the economy. Instead of going into consumers' bank accounts and then being spent on goods and services and everything else, or going into businesses who could use that money to invest, the government's taking that money out of circulation. Now, it might go back into circulation in the form of government spending, and then it would be treated with a spending multiplier. But that initial increase in taxes is pulling money out of this circular flow. So, the tax multiplier is negative. And here's the equation for it. This one's a little trickier. The tax multiplier is negative marginal propensity to consume over marginal propensity to save. So I prefer this phrasing here. Negative marginal propensity to consume over marginal propensity to save. The first statement here is the same exact thing, except instead of just understanding marginal propensity to save, we're using 1 minus marginal propensity to consume. But since step 1 is to figure out marginal propensity to consume and marginal propensity to save, then we can just understand negative MPC over MPS. Okay? So we're actually changing the amount of money that is going to get multiplied through, which is, in this case, going to be multiplied in a negative way. But guess what? If there was a tax decrease, then this would be a positive version of the same thing. Okay? So if there is a tax cut, then the multiplier is positive because now there is more money in the circular flow. So it would be positive marginal propensity to consume over marginal propensity to save. Okay, so let's do an example of a tax question. Assume that Germany raises taxes on its citizens by 200 billion euros. Furthermore, assume that Germans save 25% of the change in their disposable income. Calculate the effect of the 200 billion euro change in taxes on the German economy. So go ahead and pause right now and work through this. All right, we're back. Let's go ahead and see what we've got. Listen, the steps are going to be the same. Step 1 is going to be calculate the marginal propensity to consume and the marginal propensity to save. So 25% of every dollar is saved. So the MPS is 0.25. The MPC is 0.75. Now we're going to take that information, we're going to calculate the tax multiplier. So we're using our new equation for the tax multiplier, which is negative MPC over MPS, which is negative 0.75 over 0.25. 0.25 goes into 0.75 3 times, and this is a negative number, so the tax multiplier is negative 3. And finally, we simply multiply the tax multiplier by the change in taxes. So, the change in taxes is 200 billion euros times negative 3. So, the total impact is negative $600 billion change in aggregate demand. And that's all we're doing here. So, let's go ahead and proceed to the next slide. Let's think about this example. If the Japanese spend 4/5 of their disposable income, and we assume that the Japanese government increases spending by 50 trillion yen, and in order to maintain a balanced budget, they simultaneously, meaning at the same time they increase spending, they increase taxes by 50 trillion yen. So they spent more, and they're paying for that increased spending by increased taxes of the same amount. Calculate the effect of the $50 trillion change in government spending and the $50 trillion change in taxes on Japanese aggregate demand. So we have a tax and a spending going on at the same time. So go ahead and work through this, and you're going to need to work through both multipliers, the spending multiplier as well as the tax multiplier. So go ahead and pause and work your way through that. All right, we're back. So a little more work this time, and if you got the answer correct, and maybe the answer surprised you. So let's take a look. First, let's calculate the MPC MPS. We're going to need that for either one, right? So the MPC, marginal propensity to consume, is 0.8, and MPS is 0.2. Let's calculate the spending and tax multipliers. We need both of them, right? The spending multiplier is 1 over 0.2, which is 5. The tax multiplier is negative 0.8 over 0.2, which is negative 4. Now let's apply the multipliers. Okay, so the change in government spending times the spending multiplier is $50 trillion times 5, which is 250 trillion yen. And then the tax is 50 trillion yen times negative 4, so that is a negative 200 trillion. So the net impact of the increased spending and increased taxes is the amount of the increase in spending only. And what we find here is that the multiplier effect was essentially canceled out. So we have a word for this. It's called a balanced budget multiplier. When government spending increases are matched with an equal size increase in taxes, the change ends up being equal to the change in government spending. So the balanced budget multiplier is actually 1. Okay, so if you see on a question that there is a balanced budget like this, right? Like this idea of, okay, we're going to raise spending, but we're going to raise taxes at the same time. Well, then the multiplier is 1. Pretty easy, right? So let's recap. We've got this idea that income can only be spent or saved, right? So there's spending and there's saving. We understand what average propensity to consume and save are, and we also know what marginal propensity to consume and save are. And we know that we're mostly concerned with marginal propensity to consume and save, your MPC and MPS. And MPC plus MPS have to equal 1. And using the MPC and the MPS, we have learned a couple of multipliers. The first multiplier is the spending multiplier, and that is 1 over MPS. The second multiplier we learned is the tax multiplier, and that's negative MPC over MPS. And finally, we learned that if there's a balanced budget, the multiplier is 1, which essentially means there is no multiplier. It's the change in the initial spending. And that's everything we have today. So, good luck and happy studying.